Hello everyone, hello Finimizers. Welcome to another Finimize live event. My name is Stefan, I'm an ex-portfolio manager, now analyst at Finimize, and I'm happy to host today's event on the top trading opportunities to watch in 2024 with our partner IG. So first, let me just run through some housekeeping rules. Number one, as you're coming in, please fill out the poll. It should appear pretty soon. Feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. It's going to be a 15-minute discussion followed by a 15-minute audience Q&A. So, please make sure to use the Q&A box to ask a question. And if you see a question you like, you can directly upvote it so it moves to the top. And that way we can get through the most upvoted questions first. Okay. Let's kick this off. So our event partner today is IG, a leading retail trading and investment platform, providing individuals not just with the products, but also with the insights and the analytical tools they need to access opportunities in financial markets. I think there should be a link appearing. Yeah, there you go. Make sure to check this link if you want to learn more. And with IG, you can expect an easy-to-use platform, expert trade IDs, and a massive investment universe, as you can trade over 17,000 markets with spread bets and CFDs, or invest in thousands of global shares and ETFs. And I don't know if I'm allowed to say this or not, but I actually do own a IG account, and I really enjoy it. Just remember, your capital is at risk. 68% of retail investors' accounts lose money when trading CFDs with this provider. So, you should consider whether you can afford to take the high risk of losing your money. Okay, so let's dive in. Today, we're very fortunate to have Chris Beauchamp, Chief Market Analyst at IG. Chris joined in 2010 and quickly became a go-to expert for the financial media. You probably have seen him before, sharing insights on top financial TV networks like the BBC or Sky News. And his background is in equity research. So, don't hesitate to ask Chris any stock-specific questions that you have. So, Chris, how are you doing today?
Not bad, thank you.
Awesome. So I'm very excited. I was thinking because, we run many events for long-term passive investors. And I think, this one is more for traders or, at least for active investors. And they're really two different beasts, right? So let me start by asking you, in what specific ways should trader strategies diverge from those of long-term investors when approaching the markets? So, not just this year, but more generally, basically, what do traders need to succeed?
I think it's an almost greater awareness of risk and the understanding the need to cut losses. I think what separates good investors and good traders from bad ones really is an understanding that the markets don't always move in your favor. That every investment you make, every trade you make is a view that you take based on your view of the situation. But with trading, you have to be so much more disciplined. I think discipline applies investing as well. You don't really want to hang on to investments that are constantly going down in value. Don't go bottom fishing in stuff just because it looks cheap. There needs to be a reason why you're investing. But for trading, the fundamental rationale is that you're being driven, the price is moving in the direction that you want it to, whether you think it's going up or you think it's going down. The price has to confirm your view, really. And that's how I always look at it. The price tells you what to think about a specific market. When I look at a market on chart, I look at say an index or an individual stock or a commodity, I want to see the chart first. I want to know whether it's going up or down or whether it's going sideways, so I can sense what's the prevailing mood in this market. What's the mood of the people currently trading this market, or the dominant mood, shall we say? Where's the short-term trend? Where's the longer-term trend? And how will I look to exploit that opportunity? And with trading, because frequently using leverage, as you would with IG and a number of other providers, you then obviously have that risk of loss. And you need to make sure that you know, okay, I'm getting into this position now, but what's my rationale for getting out of it? Where's my stop? How much am I prepared to lose on this trade? Because it's far more important to think about what the risk is in a particular trade than worrying about or thinking about, well, I'd like to make X amount on it. Because the one thing you can control when you're trading, indeed when you're investing as well, but particularly for trading, is this is how much I'm prepared to lose and no more. So say you buy the FTSE 100, say you're trading with an account, just to keep the numbers simple, of £1,000. Usually you say you risk no more than 2% of your account on any one trade. So you're risking about £20 of £1,000 account. And so you're saying, if whatever position I'm taking, I think it will do this. But if it moves against me, this is how much I'm prepared to lose maximum. And that's a hard stop. I think at 2% is definitely the maximum most people should use. Others, I think, would go for less than that, really. And that's where, with an investment, of course, you're still holding the shares and value. By £10,000 worth of BP shares or whatever, you've still got some of that value, even if they decline by half. But if you're trading it, the risk is there of losing a lot of money very quickly. You have to be honest and open about the risks that go with it. And so we're trading, you need that iron discipline. A lot of companies, including IG, find when they look at their client base and they survey their clients, is the people are very, when they trade a lot, they often cut their winners too early, but they also hang on to their losing trades. And so that means they end up with bigger losses, and they plan. Nobody plans to go into this to lose money, but they often end up that way because the risk management just isn't there. And it's not the most fun part of trading. It's not the most exciting part, but it is the most important part to consider when you're trading.
Awesome. So a focus on risk management, and especially on cutting losses, discipline, having a clear plan in advance, of course, and basically price action that confirm your views. So those are, in a summary, kind of what differentiate traders from long-term investors. So now let's move on to 2024. How's that looking in terms of opportunities, specifically for traders?
Well, the year abounds with opportunities. The beauty of trading with someone like IG or other providers is you've got those thousands of markets on offer. You can trade in various timeframes. You can do it different ways, either through spread bet or CFD, or you can use the options, or of course you've got the stockbroking platform as well. But the opportunities are always there. We're 2 months into the year, and we've had already multiple record highs in US indices and in European ones as well. You've got the Japanese Nikkei hitting its highest level since the beginning of 1990. So we've already had astonishing moves in markets, but I think a lot of it will continue in a similar vein. Really, we're in a presidential election year. That means US stocks are hugely in focus. Really, they dominate the market anyway. The US is 50% of global market cap. But in the election year, there's a huge focus on that as well. So the opportunities will come through. The likelihood is that we'll see increased volatility this year. Volatility as a whole has been quite low, but that's likely to pick up around events. Certainly the US election being an obvious one. I think that's one area that will throw up lots of opportunities. If you look at previous US election years, there's been a huge focus on whether maybe, say, bank or industrial stocks will do better because of the policies, depending on the president. Now, 2020 was a bit of a different year, shall we say, thinking back to COVID and lockdowns. But if you look at 2016, the last time Trump ran for president, of course, he won in that year. That was a shock. That year, that was a really volatile year, and the surprise was that Trump won. This year, I suppose the opportunities are maybe slightly different because it's already happened once, so markets are more understanding of the possibility that it might happen again. And so if you look at the polling, it's still a very real possibility, I think, that Trump could win the election. And so there'll be people looking and saying, well, maybe energy stocks will do better under a Republican president than they would under Joe Biden because of the focus the last few years has been sustainable energy. Maybe there'll be less of a focus on solar stocks and other kind of renewables, really. So that's one big area, I think, where we're focusing on. And then the other thing, of course, is the inflation story. That hasn't gone away. That provides huge opportunities as well. 2022 was the year of surging inflation and rising interest rates. 2023 started to see inflation come down. Interest rates kept rising, but markets, if you look back over the past year, stock markets did very, very well generally, because I think everyone came into 2023 expecting a recession. One didn't happen. That caught people by surprise. This year, the opportunities are around maybe a resurgence in inflation. It's a possibility. Certainly, the last couple of months of price data in the US have been pointing towards that. But also that it might continue on its downward path, not to be a typical analyst and try and give both sides of the story. But I think we're looking at a year where you could justifiably see two very different outcomes. You could get what the Fed calls a soft landing in the economy, where growth doesn't go negative, where inflation keeps coming down and things continue to grow. I think that still is the base case for most people. There is the risk that you get inflation coming back again for whatever reason. That means central banks have to hike again. You might see more strength in the US dollar. And that could upend a lot of narratives. And having seen stocks gain so much since October on the expectation really that the Fed will start cutting rates, if that doesn't happen, and if they actually start raising rates again, maybe we're in for some volatility in equity markets. I don't think you'll see a full-blown bear market again like 2022, but you might see quite a bit of volatility creeping back in again.
Thanks, Chris. Now, which sort of trading strategies, you would say are looking particularly promising for retail investors in 2024? Maybe you can, define what you mean by trading strategy.
Well, it's the way people will approach the markets, the framework they're using. And with IG, you see a huge number of different trading strategies. Some people will go with the trend, which is the classic one. They look for a price that's moving in a particular direction and they go with it. And they look for an entry point. Every trend, whether it goes up or down, has sort of waves and then retreats, if you like, and prices move with the trend and then against the trend. And sometimes you argue that you're trying to get in a better point and buy the dip, as people say, over the past 10, 15 years, of finding that weakness in stocks and entering it. Now, with the stock markets and particularly tech stocks so strong at the moment, that can be quite frustrating because you don't really everyone's waiting for a pullback in tech stocks that hasn't arrived yet. And that's quite frustrating. With the strategies that really define successful traders from unsuccessful ones is that they go with the broader trend. We do have quite a few traders at IG who will happily counter trend, but the risk is sometimes that a move goes on, just as we've seen in stocks over the past 5 months, that you get a move that goes in one direction and keeps going. And I think this is what, when you're going back to the first question about differentiating trading from investing, it's being ruled by what the price action is telling you. Using indicators to an extent, but also trying specifically to understand what the message the market is sending. This stock is going up in price because the market thinks it's doing well. There are markets that are going down. If you look back to 2023 again, the consensus in January 23 was buy China, sell the US. In fact, doing the exact opposite was what turned out to be the best strategy, because Chinese markets have really been struggling with huge outflows, poor economic performance. That has continued more or less into the beginning of the year, actually. You've seen some recent strength in Chinese indices because they're talking about propping up the market through using state-backed investors, but you've also got a lot of weight of outflows still driving that down. So you've got a big rebound in Hang Seng, but is it going to go further? That's one to consider. I think the thing that investors and traders get wrong is that they misunderstand how far trends can go in one direction, and that something can't keep going up because it's gone up a lot, or it can't keep going down because it's gone down a lot. And there are plenty of examples on both sides of companies. Beyond Meat was one I saw recently where the share price just keeps going down and down, and there's no sign of recovery because the fad that drove it higher has disappeared and it doesn't look to be turning around. And people think, well, it's now cheap. Yes, it is, but it's cheap for a reason. I think it's the trading strategy that perhaps, particularly with equities, works best is to marry that technical view, looking at the price, with the fundamentals. Where the two line up is when things tend to do best. And declining stock prices are a message that the market doesn't think this company will do well. Conversely, with Nvidia, as we saw last week, rising stock prices are a sign that over the longer term, the market thinks it will do well. And I think going with the longer term trends is always the best way to approach these things, particularly in trading.
Also, the biggest momentum trade, I think, of 2024 is really long US tech, and especially the Magnificent Seven. So how can traders best play, that trade? Like, as you said, they have to go long as long as the trend is up. How would you determine when the trend is not up anymore, or when the fundamentals change, or when price action tells you to exit the trade? Should they just use, trailing stop losses, or what's your view?
Yeah, I'm a big fan of trading stop losses because it allows you to keep on some of the position without having to surrender all the profits you make. So when you put a trading stop loss on the platform, it follows at a predetermined distance and then remains there. And if the price suddenly drops back again, you can get stopped out at a higher level so that you're locking in those profits as you go. I think with looking at things like Nvidia, the Magnificent Seven, they've come a long way. And sometimes it does require the patience. You can use maybe shorter term charts. You can look intraday to find entry points as well, but understand that that's maybe leaves you open to the risk of over trading. I think there's always the possibility of a pullback. You can say if it drops to a certain moving average, if using short-term trading, you can maybe use a combination of the 20 daily moving average and the 50-day moving average, and the 20-day drops below the 50. That's a sign that short-term strength is given way to short-term weakness. Trying to spot turnarounds is always a bit tricky in markets because everyone wants to think they can spot a turnaround in real time, and usually they get it wrong. Everyone does that, whether they're a retail trader or professional investor. But looking for the weakness in trends. So the average year in the S&P and in the Nasdaq sees a pullback of at least 3 or 4 pullbacks of 5%, maybe 1 or 2 of 10%. That's just your average year, whether it's going up or down. Generally, that's your average year. So we've seen it have a very strong start to the year. If you look at previous election years, you often have weakness particularly in May, and then it rallies over the summer. So there might be at some point a correction. We should expect one. We just don't know when one will arrive, and it's very hard to gauge market sentiment. You think maybe Nvidia earnings last week might have been the spark for a pullback. Maybe they weren't as good as expected. In actual fact, they were even better than expected. So that's all reactionary markets once again. So it's try not to anticipate, I think, is the key thing for all investors. We want to think we know what's coming next. The best way to approach is that you don't know what's coming next, and that's why your stop's in place. And as you say, with trading stops, you can take a position and you don't have to lose all the profit if the position moves against you.
Awesome. Before we move to the Q&A, and by the way, please share your questions on the Q&A box and upvote the ones that you want to see most answered. I don't see any questions so far, but let me start by asking you a question. What are your top tips really for 2024? And I think you said at the very beginning, cut your losses short, let your winners run is a kind of typical one. Any other kind of typical, any other specific top tips for 2024?
I think when you're trading, you have to be aware of what's going on in the background with news and news flow. You can't escape news in financial markets. It's almost, we get too much. I think you get too much information really as an investor. There's the urge to be always trading all the time, to constantly have a view. I think there's investors and traders will do better if they are focused less on the headlines. It's easy to get caught up in the day-to-day volatility, to chase the latest thing, really. Know the markets you want to trade, I think is the most important thing, whether it's FX, whether it's commodities, whether it's equities or indices. And in many ways, stick with those. Understand the market you're trading. Know what events affect it, when they come out next, what's the expectation. And try, as I said, try not to guess what's going to happen next. It's really, really difficult, because even if you knew what a specific data point is going to be, say we've got US PCE inflation this week, which is the Fed's preferred guide of US inflation. That's coming out Wednesday. Even if you knew exactly what that number was, you don't know what the market reaction is going to be, because a lot of the volatility you see around events, whether they be earnings like Nvidia last week or data points, it's a sort of unwinding of positions people took before the event. And you often see the market swing around quite wildly around these events. And the risk is, as a retail trader, that you want to be involved in that, because you see the market moving around, you see the price swinging around, and you want to get stuck in and have a trade on, because it's exciting, it's human nature to want to get involved, and you think you're missing out. Often with events, it's best to step back and await and see how things settle down. There's always another day, there's always another possible day for trading, or another market to trade, or another position that can crop up over the course of time. I can see someone in the chat saying always do the opposite of headlines. It's very true that usually by the time something really hits the headlines in terms of its price movement, a lot of that move has happened, at least in the short term. So oil is a classic one. By the time everyone clocks onto the fact that oil hits 6-month lows, a lot of the selling is already done, for example. Now with stocks, they're all-time highs. There was a couple of headlines I saw this morning. Larry Fink, famous investor, was quoted as saying you should be 100% in equities if you can stand the volatility at the moment. But if you look back 8 months ago, when stocks were at their lows for the year, he was saying, oh, we should be cautious, things could get worse. And so journalists are looking for headlines. In investors, you have to remember that their task is different. They're not there to try and give you investment ideas now, but themes to look at. So yes, stocks are at record highs. They'll probably keep going, but there might be a pullback on the way. So you have to be very careful about jumping into stuff without doing your homework, really.
So actually, it's funny you mentioned that. So I wrote an article 2 weeks ago on the magazine cover indicator. If you were to take the opposite view of the Economist front cover, so if they were bullish on something, you would go short. You would have made 10% over the next year on average over the last 20 years, which is pretty remarkable performance for such a simple indicator. So yeah, do the opposite of the headlines. Doesn't seem to be a terrible strategy. Now let's move on to the Q&A. So we've got a question here. Okay, let me just order them by votes. Okay, is the AI market a bubble which is due for a correction soon, or are there opportunities still available?
Yeah, that's a really good one. And I saw someone once define as a bubble as something that's going up that I'm not already long. And I think that's always a good one. You think something can't keep going up. I don't think it's a bubble as such. Um, Certainly valuations are a lot higher than they were 6 months ago. But if you look in Nvidia's case, that's backed up by the huge amount of revenue and cash they're generating. So there's a lot of energy, I think, left in AI in the longer term. Maybe now the focus shifts from the companies that make the stuff that powers AI to the companies that use AI. That's one of the possibilities that this sort of moves on from one story in the AI drama to another one as the companies that really benefit from it. So that's a possibility that you could look at particularly. There will be a correction at some point. I think it's safe, as I was saying, you should assume that there'll be a correction of 5, maybe 10% in the NASDAQ. Maybe if I should share my screen earlier, but if we actually pull up a chart of where we are in terms of markets, I use the IG trading platform. If we look at the NASDAQ, hopefully you can all see it. Shout if you can't. This is where we are now, just knocking on the door of 18,000. If we dropped, say, 1,000 points, that's what, 7%, I think it is. Right now, after the big move we've had just since the beginning of the year, of 1,500 points or something crazy, that would feel really, really dramatic at the time. But actually, it wouldn't be much of a pullback in terms of this huge gain we've had since October. But it could be an interesting entry point that maybe some of the froth comes out the market and then it starts to move up again. The important thing to remember whenever looking at charts is that markets go up and down, not up or down. So you get movement in both directions. I think a lot of people looked at this pullback in the Nasdaq at the end of last year. It lasted all of a week, but people probably thought, oh, it's that's it now. We're going to go much lower from here. And then suddenly you get another 1,500 points. And this is the other thing when you remember trading trends, the prevailing direction of the trend sees the bigger move. So you have a big move up, short-term pullback, big move up. If we went to the opposite extreme and looked at the Hang Seng again, I was just looking at the Hang Seng this morning because it's had a big bounce, but you can see how it's rallied. And then if this falls back again, we could see another big leg down as the longer term trend reasserts itself. So that's how I would approach it. Yes, AI stocks are all the rage at the moment. They could go further, but I think that the most important thing to remember is that there's always some volatility around that, and then it might be better rather than chasing it now after the huge move, waiting for that move. Unfortunately, because I haven't got a crystal ball, I can't tell you when that move will begin, but it makes sense to expect it.
Thanks, Chris. Another question, kind of similar. Do you think there is a correlation between the tech industry today and the tech bubble in the 2000s?
No, I think honestly, it's one of the times I give an actual straight answer. I think it's no. It's gone up a lot, yes, and there is a lot of mania. But again, it's looking at the actual fundamentals of these companies. Back in 2000, the web was still in its infancy, really, and making money off the web was very, very hard. A lot of these companies, even if they had some revenues, had no profits at all. And the share prices were going up and up and up because they were going to change the world tomorrow. Fast forward 20 years. And to be fair, we've been talking about tech companies in the bubble for the past 15 years, really. But if you fast forward 20 years to where we are now, or 25 years ago now, the situation is different. These companies throw off huge amounts of cash. Their valuations, they're not even for the Magnificent Seven, they're not astronomically high. These are not triple-digit P that we're trading on now. We had a huge drop in a lot of these names in 2022. They've had a huge recovery, yes, in 23 and so far in 24, but it's a very, very different world to what it was, I think, then. Internet is far more embedded in society. AI, or call it what you will, the beginnings of AI are just beginning to take hold, and that will change things in ways we don't know. You shouldn't be blind to the risks of volatility, but I don't think just because they've both gone up a lot, that is probably where the resemblance ends with 1999.
And I think this is really when having a trader's approach is really valuable, right? Because here you can have a view. This is different. This is not a bubble. Yet, if they start to drop, you're not going to be like a long-term investor just suffering the drop and suffering and suffering. You're super disciplined. You cut your loss short. You've got a trading stop loss in place, and you limit your losses, even if your thesis is wrong. So I think this is actually a perfect example of when having a trader mentality can really add a lot of value compared to a kind of long-term investing one. Next question. Given the volatility we've seen and expect to continue to see in the markets, what role do you see options playing for retail traders? Would they play a key role as a form of insurance?
Yeah, I think they do really. The beauty of options, of course, is that you get the direction, but not sort of worrying about the intraday price movement. So say you think, for example, that the Dow is overvalued at these levels, and it needs a pullback of 1,000 points or so. You can look to use a put to take that view and just leave it to run until expiry, say it expiry in March or in April or beyond, and you're not having to worry about that short-term volatility. You're looking, maybe think it will keep going up, but as we say, it's due a pullback, and you think it might happen some of the next few months. So the put would be a good way of expressing that, really. So yeah, the options element, I think, is important to consider. It does require that extra bit of knowledge. You've got to do a bit more homework in terms of the options, but the same things in many ways apply. Don't try and make it too complicated. A big failing of retail traders, and we all fall prey to, including me, is to overcomplicate stuff. And you can read up on vast amounts of option strategies, and a lot of them probably don't need to think about. Really try and keep it simple, try and keep it relatively directional, particularly. But yes, they make up an important part of NAMA. They're becoming an increasingly important part of the market as well. There's a lot of focus on these naught daily expiry options and how they're driving market activity. I think probably some of the worries about that are overdone, but it's a sign that options are increasingly becoming a part of most traders' toolboxes.
I see some people asking questions on the chat. Just make sure to ask your questions on the Q&A box. Otherwise, I can't see them and ask them. Next question, how can we leverage sector rotation in identifying trades?
It's a good one. You can use, there's quite a bit of focus now on sector rotation. Look at the relative strength among sectors, which ones have done well so far this year. Again, the story moves on from one to another. So I'd keep an eye maybe in broader bull markets, such as the one we're in now. Keep an eye on the underperformers, because often things start to turn around. Again, as a trader, use the price action is the most important thing. That's where the sector rotation shows itself, that the market goes superior to one sector leads, and another one takes over. At the moment, it's all about tech, but it's not just tech that's doing well. It's healthcare. Energy stocks have seen quite a bit of a tough time. So you can use sort of the macro themes to take a view on that. But definitely, I think sector rotation as well is an important element to consider. Look at the sectors, and then look, if you like, to the strongest names in those sectors, if you're looking to go long, or look at the weaker, look at the underperformers, look at the stocks that aren't doing what everyone else is doing. That's where you can often find interesting trade ideas.
What are key KPIs you use to spot momentum?
Yeah, you can look certainly at if you're looking maybe for volatility as well as momentum, you can filter by price gain. You can use the IG market screen. You can say look at percentage change over the course of the last 6 months or the last year. That's one way of doing it on the IG website. If you look at technical indicators, looking particularly for volatility, things like average true range, which measures the average daily move on a market over a set number of days. That's one way of looking at the stuff that's moving around a lot, because all markets go through periods when they're quiet and periods when they're busy. And it is true that most markets that move higher tend to see less volatility. Stuff that's going down tends to move around a lot more. Downtrends are a lot more volatile than uptrends. So you can look at that as well. But ATR would give you can put that on your chart as an indicator, and you can flick through charts and you can get a quick eyeball of, is this moving around a lot? Is this not moving around a lot?
Now, another question on a specific indicator. How effective is the MACD, MACD analysis to determine entry and exit points on the trader, and how do you usually use it more efficiently?
Okay, let me just share my screen again, because I can add it on and sort of show as we do. I use it to an extent. I think it's very helpful. I just need to find my relevant window. There we are. To get a sense of the trend that things are moving in, really. So at the moment, I've not added on, so I'll put it on here. What this looks at is two moving averages, essentially, the 12 and the 26. And it gives you a sense of, it matches what the price is doing, really. And my argument is that the MACD should reinforce what you can already see on the chart, really. for example, here, and this is the Hang Seng again, longer term downtrend. This is since August. And you can see these, what they call bearish crossovers on the MACD, where the shorter term moving average crosses below the longer term. That's your trigger to go short, if you like. Now, all indicators are lagging. They won't happen immediately. You could say that if you didn't use that, you could have identified the high already without the MACD, because the price starts to move lower and then you get the negative crossover in the MACD. It's a slightly slower moving indicator than, say, stochastics, but that often means that you have fewer whipsaws where you get stopped out as an incorrect view, where the MACD moves lower and then turns around again. So, for example, here you get a few where you get false signals. But I would use MACD just to confirm what you can already see in the trend. I tend to have, as you can see here, 3 moving averages on a chart and the MACD as well. You can use stochastics in a similar way to help you just clarify your thinking, I think, is to see where these lower highs are in the downtrend. Indeed, where the lower lows and where the crossovers are for rebounds as well. So you've had a big ones there since sort of late January. You can see where the MACD crossed higher, but you do risk. You do have to know that because it's lagging, you often get a big move and then some short-term pullback. So you have to be careful with your stops and your position sizing when you're using it. As I say, indicators should confirm what you can already see on the chart. They shouldn't be telling you they shouldn't be telling you to do something that isn't being backed up by the price action itself.
Chris, thank you so much. I'm afraid that's all the time we have today, but this was extremely insightful. Thank you so much. Thanks everyone for joining us. Hopefully you also found that extremely valuable and you got some practical tips as well. Well, see you at the next Finimize event. Chris, once again, thank you so much. And everyone, have a great day. Bye-bye.
Thank you. Bye-bye.